Today I'm speaking with Tim Melvin. He has over 30 years of investing experience. He's worked as a stockbroker, advisor, portfolio manager, writer. He's a very prolific financial writer. His investing style is very much deep value orientation. He's also the author of The Off Wall Street Wanderings of a Curious Mind on Substack. And that's a great read that you should check out. It's got audio content, it's got video content, and a lot of written content with a lot of good thoughts and observations on markets. So welcome to the podcast, Tim.
Yeah, thank you very much. I was looking forward to being on here. We just got back from vacation up in New England, and I walked in last night and I said, I really should sit down and prepare for this podcast. I said, no, we're winging this one. We're just going to see how it goes. So,
all right. Well, I'm sure it's going to go awesome. So what's your backstory? How'd you first get the bug and get interested in investing?
Well, I was working for John Hancock Financial Services. A friend of my dad's got me the job because I was actually selling Electrolux vacuum cleaners door to door, which is a great job in the summertime in the Baltimore area. In the wintertime, it's not as desirable, we shall say. So he got me a job with John Hancock. I was selling life insurance and mutual funds and variable life. And Hancock was kind of pioneering the insurance company model of financial planning back then. And I figured out yesterday when I was in Boston staring at the Hancock Tower that I actually got licensed for the first time in 1984. So this is going to be 40 years this year, which I started clearly when I was 6 years old.
Congratulations.
Thank you. And then I moved to California, staying with Hancock. And in our office plaza out in a little town called Merced, California, in the San Joaquin Valley, there was John Hancock and there was E.F. Hutton. And something I noticed right away, the Hutton guys drove nicer cars than I did. They came in earlier. They were at work at 6 o'clock in the morning, but they were gone. 3 o'clock in the afternoon, they were to the golf course, happy hour, wherever it was E.F. Hutton guys went back in the day, because we're all the way back on the West Coast. And I was attracted to the lifestyle. Of course, we're doing mutual funds and variable products, so familiar with the markets, learning more every day. I started hanging out quite a bit in the E.F. Hutton office and, trying my hand, trading little pieces of stock. And I desperately wanted to be a stockbroker. I mean, at that point, the lifestyle, the money, my fascination with the markets really drove me to want to be a stockbroker. So I literally, because don't tell anybody, I never went to college. Okay. So this is like 1984, early 1985. I want to be a stockbroker. We're in the middle of the first bull market since the 1960s. And I knocked on every brokerage door in San Joaquin Valley, went in, met with the manager, got turned down everywhere because not only college, they wanted MBAs. Because that's kind of where the brokerage industry was in 1985. I did not have I don't think I'd ever set foot on a college campus at that point in my life. The guy at Dean Witter in Modesto, who I still stay in touch with today, liked me. He thought it took a lot of chutzpah for this young kid to walk in and just say, hey, I want to be a stockbroker and I have no credentials or experience whatsoever. Give me a shot. He put me through all the aptitude tests, which I crushed because by this point, I'm reading Barron's and Wall Street Journal. So I've got a pretty good working knowledge of basic securities regulations. And they gave me a test on cold calling. Now, I started out of high school selling books door to door, and then I had gone to Electrolux. I've had dogs turned on me by this point. I've had people threaten to hit me. So people hanging up on the telephone was not scary to me.
That's probably better training than college for the industry.
Yeah. Harry Truman actually sold encyclopedias for a summer, and he said he learned far more there about the human condition than he did in college.
Yeah.
So I'm fearless on the phone. And so I passed all that, but they still wouldn't hire me. And he even made a special appeal to just said, no college, we're not hiring the kid. So we just go along doing what we're doing. Then the crash of 1987 comes. So the thing about MBAs can't sell for the most part. It's beneath them. I'm sorry if you took that personal with an MBA, but it was the experience that the brokerage industry certainly had in the mid-1980s.
Yeah.
So they called me back and they gave me a shot. And, I took to it, cold calling all day with tax-free mutual funds and preferred stocks. And we had a stock of the day. I'm going to make this story real quick or we'll be here all day. They had a stock of the day every day. I was at Dean Witter. And they had a stock of the day that was a sales pitch with a script and everything. So I was cold calling with the stock of the day because this was the greatest story ever. Remember where we are now. We're in 1988 by this time. been through training. I'm licensed. I'm security. The women back to work was in the second stage of the wave, but it was still happening. So there's a chain of, and they're still in business, so I'm going to make them nameless. There was a chain of daycare centers. Okay. And this was a great story, trading at 20 times earnings, but growing a massive growth potential.
Fantastic story.
Oh, fantastic story.
Yeah.
And I was good at telling it. So I'm cold calling, I'm getting people to open accounts. And because, when you're really passionate about something and you can come across with it as passionate as I was about that particular stock, people kind of got caught up in it. And so give me a trial, try me out, 100 shares. And we built up a bunch of accounts. And then they announced earnings. And it was not good. There were people touching people where people weren't supposed to be touched, and they had self-funded their insurance policies, and earnings crashed, and it was tearing. The stock was down 50%. I said, "Man, I don't know what I thought I knew," and did nothing about my passion for being a broker, but it made me realize I got to do this differently. Mm-hmm. We had a guy in our office, and again, I call him the professor, who remained nameless. He runs a large money management firm today, and I think he'd prefer to be nameless. But he sat in the office, and he was cranking out returns. He was doing, I think when they finally audited him, he was doing 27 point something a year.
Whoa. Okay.
Yeah. And you could tell him the ticker of some obscure energy company. He'd tell you what their oil in the ground reserves were worth just off the top of his head. Wow. This guy at very Ben Graham, very distressed investing. So I bugged him until he finally said, "Look, kid, read these two books." And he hands me these two big, thick books, The Intelligent Investor by Ben Graham and The Aggressive Conservative Investor by Marty Whitman. He says, "You read these two books and you come back and we'll talk." Now, he figured that was the end of me. He didn't know me very well. I love to read. I'm persistent, and I really wanted this. So I went home on Friday night and just ignored my wife, the kids, everybody, locked myself in, and I read both books.
Wow. And one night?
No, weekend.
Okay, a whole weekend. Gotcha.
Over the weekend.
That's it's a dense book to get through in a weekend.
Well, I read both.
Wow. Both dense books to get through in a weekend. Yes. Okay.
And I came back with questions, and he just was like stunned that I'm back. But from that point on, he really kind of took pity. I don't know what it was, but he taught me a lot, and he gave materials to read. And, R.D. Smith was a brokerage firm up in New York at the time that was doing a lot. And by the way, R.D. Smith is Randy Smith today. That's Alden Partners. He's the guy that's plundered all the newspapers. So, but at the time he was very big in distressed debt, and we used to get his research faxes. So we were poring over those and doing distressed bonds, which was so much fun to cold call with because it was different. And you just really kind of learned the business, and it all took off from there. And eventually found my way back to the East Coast. But that's where the bug and the fire was lit as a deep value classic, kind of Graham and Dodd based investor. And it just grew from there. So that's a very long answer to a short question, but I don't have the usual backstory.
No, that's awesome. Yeah. And so starting in the wake of 1987, so what was the mood like then? Because today we look at it in like a stock chart and you're like, oh, the market was back in a year. What's the big deal? But I know at the time, the emotions of people on the phone must have been much different than that. So what was that like dealing with the wake of that?
It was difficult because, and also remember now 7-8% CDs were normal.
Oh, okay.
Okay. So you're calling people and you're like, blah, 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 do this. They're like, hey, wait a minute. I have 7% in the bank, lost all that money in 87. People were scared. The market had burned them. They remembered the horror stories because everybody's parents or grandparents at this point had been through the crash in the 20s too. Right? You're only 60 years difference between them at this point. So there were lots of memories of the Depression and then the crash of 87. So people were scared. They were nervous. They weren't sure what to do. You had the junk bond markets were imploding all over the place, and Michael Milken was going to jail, and Ivan Boesky. And so there was a general distrust of Wall Street. So you really had to be different. And what I kind of figured out very early on was one of my best possible markets was real estate brokers and investors, because they routinely took risk for a living and they had to do something with their IRA. And so we really kind of focused on those guys and told the stories, and we tried to get into the hedge fund side of things unsuccessfully for a very long time, but eventually got into brokering for some of those guys. And you just went looking for people that dealt with risk in their life. And they were a little easier to work with. But the mom and pop calling them up, you better be selling a preferred stock or a tax-free bond or something along those lines, or you got shut down.
Gotcha.
I mean, my own mother closed her account. So
Oh, wow. Okay.
yeah. And she just had mutual funds, but she was like, I'm too scared. I can't go through that again.
Well, I mean, if you can make 8% in a CD and then the long-term return of the market is like 10%, I mean, I for a lot of people it'd be like, I'd rather just make 8% in a bank. Like it's way easier.
Yeah. And the 10% a year sale was that was a tough thing to get people to buy. It was a lot easier to get them to buy them buy that in 98 than it was in
Yeah.
88. Okay. Because you're just sitting there going 10%. Hey, pal, I'm down 30.
Gotcha.
So it was different, but and a lot of people failed out of the business. I think there were two of us out of the graduating class that I was in that are still somewhat associated with the financial industry.
Wow. So you mentioned reading Ben Graham as a major influence.
Mhm.
So in addition to Ben Graham, who have been some of your major investing influences? And are there any books that they wrote that you really enjoyed?
Well, absolutely, Marty Whitman. Marty Whitman's aggressive conservative investor, and then he did a modern value investor, and he also wrote a book on distressed investing. But if you're not really passionate about learning distressed investing, don't read that one. It's a tough read. But Marty's and his letters to the chairman book, I believe that's the title of it. I could pull it off the bookshelf, but he has the compiled 30 some years of letters. And that's just absolutely mandatory reading. And then Chris Brown at Tweety Brown, those guys, and this was before Tweety Brown got huge. Okay. Tweety was Ben Graham's broker, and they accidentally took over a closed-end fund and ended up registering and becoming a money manager. But at the time, they were still doing a lot of net stuff. And I actually sent a letter to Chris Brown and got to be friends with Chris. And he was a huge influence on the way I looked at markets and approached things. And just full disclosure, Chris did write a book. I ghost wrote the book with Chris, The Little Book of Value Investing. It's really good, folks. Buy that book. I mean,
Yeah, I've read it. That is a good book. I had no idea you were involved in that. That's
yeah.
cool.
I took all of Chris's writings and everything and kind of wrote it, and then he did an edit. And I was good friends with the lady running that division at Wiley Publishing at the time. I met her through Victor Niederhofer, and another long story we could go down a side rail on, but got to be friends with her. So I worked on Chris's book. I also worked on Louis Navalier's book and David Darst and Hillary Kramer. And it was all fun. But Chris had a huge influence on the way I view markets and life and a lot of other things. And of course, Seth Klarman, you're not supposed to say it, but you can get a PDF of Margin of Safety on the internet and download that. And then more recent, I did like a whole hour video on books that I think people should read not long ago, and I barely scratched the surface. But Wes Gray and Tobias Carlisle did Quantitative Value. Both brilliant people that I won't call them close friends, but they're certainly good acquaintances. And then Wes has gone further with Quantitative Momentum and Do-It-Yourself Investor and mandatory reading. I can just go on and on and on because I really am self-taught, and it did all come from books. Hillary Rosenberg's Vulture Investors. I think everybody should read that one. But you start like I did with Intelligent Investor and Aggressive Conservative Investor and work up from there.
Very cool. Yeah, and Tweety Brown, they have that great paper, What Has Worked in Investing, which I think is really good, where they go over all the different price ratios and approaches that you can use, and they back test them and include a lot of the research. That's a good one.
Yeah, and I wish he'd update it, but he hasn't in several years. But James O'Shaughnessy, What Works on Wall Street, also does the same thing, and he does various combinations and what works, and just all fantastic stuff. And like I said, I can go on and on and on about the books that you should read. And my rule of thumb is read everything.
Yeah. That's good advice. Yeah. And Toby, you mentioned Quantitative Value. He's been on this podcast twice, and he's awesome. I really like dealing with him. He's a good guy.
Such a great guy, and just, absolute adherence to the principles that he knows works. He's willing to ride it out and deal with the volatility because he believes in it and he knows it. He knows it works. It's just a great guy.
Awesome. Yeah. So so we've talked a little bit about deep value and your influences. So what How has your investing evolved over the years? So are you still like mainly focused on like asset value? Have you moved more towards earnings value? What has your journey been like over time? Like, and how has that changed?
Well, over time, I mean, still, the first thing I check every week is we look at the value-based, asset-based situations, because at the core, as individual investors, we can do something with this, right? Now, here's our biggest advantage over institutions, right? My two favorite areas of the market, deeply undervalued common stocks of operating businesses that have solid credit. There's the Marty Whitman sneaking in, right? So if they're good businesses and they have good credit, right, and they're not making buggy whips or CD-ROM discs or something that's got an expiration date on it. And if you're confused about whether or not a business has an expiration date, ask your kids. They know. So
It's good advice.
yeah, so those are my first love. Followed right there, it's small banks. If you came to me and said, this is the only thing that you can ever do, I'm buying small banks under book value. Small banks with plenty of capital, solid credit reports. Again, the credit report here, we take the loan portfolio. We're looking not just for good loan quality right now. We want a history of not being stupid. Like right now, it's really easy to have a solid loan book, right? Because there's no credit problems in the banking industry. I don't care what the headlines tell you, there aren't any at the moment. What were they doing in 2008, right? Were they chasing those 200 basis points? Have they given into stupidity? Because all banking crises are a function of banker stupidity. Always. I mean, there's never been a full-blown banking crisis that didn't happen because bankers started doing stupid things. So you want to. I saw back last year when we had a little mini banking crisis, the carefully manufactured banking crisis that wasn't, as I like to call it. A friend of mine posted a tweet, and it was a picture of a guy with cuff slacks and loafers with tassels on them. And it just said, if your banker looks like this from the knees down, you're okay.
Okay.
It's supposed to be a boring business.
Right.
So if you can buy good, solid, boring banks below book value, eventually we've got too many banks. The consolidation wave is ongoing. It's going to go on for a long time. We're in kind of a lull because this administration is very anti-merger and B, anti-bank. That changes over time. We're starting to see some activity pick up. The merger wave's not going away, so those banks will get taken over as time goes by. So so that's core. I started doing the small banks in 1990s. But as you go along in life, you start to realize there are other things beyond just what you believe that work. Like, for instance, I worked on Louis Naviglier's book, and I had the occasion to go to his house in Palm Beach when we sat down to work on it. Now, Louis is the ultimate growth guy. It's growth and momentum purely. And I sat down and look, Louis got a nicer house than I do. And it's not that I got a bad house. It's Louis got a really nice house, and his one in Reno is bigger.
Wow. Okay.
So, and Louis, by the way, is just a fantastic guy. Every time he's in Orlando at the Money Show, I try to run up and have breakfast or dinner with him. So, and then I had a friend in Chicago, and we'd go from his house at State and Division, and we'd walk up to Wells, to Old Town, to the bars up there, and we'd go right by Richard Dreehouse's house. Also, momentum, small cap momentum. And it's a big house. It's huge in Chicago. So obviously there are things besides deep value that work. Mm-hmm. And if you look at small cap momentum, okay. And now here, this works best with small cap. You don't need to be out there trying to play with Fidelity. Okay. But when you get in the $500 million and under companies that have twin momentum, that is the Peter Lynch model, right? High earnings growth, high revenue growth, expanding profit margins. The analysts are starting to pay attention, and the stock is starting to outperform. And Wes writes about this a lot in Quantitative Momentum. You want really smooth up and to the right momentum, right? You want the lowest volatility possible with strong upward movement driven entirely by fundamentals. That works every bit as well as deep value does. And getting that confession out of me, who is a dyed-in-wool member of the Church of Graham, was tough. But I went back and I tested it, and I've tested it many times and constantly, and it works. And what's really cool about it, and Cliff Asness at AKR did a great paper on this. If you put 50% of your portfolio in deep value, whether it's deep value banks, deep value operating companies, or a mix of those two, and half in deep value small cap, not deep value, small cap twin momentum,
Mm-hmm.
both are going to have very high returns. But when this one's way up, this one will be down. And when this one's way up, this one will be lagging. So you tend to take the two zigzags and smooth it out just a little bit and still get to the same destination over a long period of time. So it's a really valid philosophy. I write about it a lot. We provide a lot of information on it. My kids use it. I don't. I'm old and I'm old school. And if you look at my portfolio today, we're banks, some small, deep value situations, and lots of deeply discounted closed-end funds.
I see. Yeah. And with that momentum, so like I think it's important because you mentioned that it's not just price momentum, it's also fundamental momentum. Like, do I have that right? Yeah.
Yeah. And one of the questions you asked me was about uranium. So I'm going to use uranium as an example. Okay. First off, full disclosure, I am wildly bullish on uranium long term. In the short term right now, there's way too many people are excited about uranium. Okay. If you look, and here's a great rule of thumb. Here's how you know a sector's overheated and getting ready to go pop. If you get a lot of newsletter of email from newsletter promotions and market promotions and that type of thing, as most people do, because you end up on the list if you click on anything, right?
Right.
If you start to see a lot targeting anything, whether it's AI or uranium or anything, that it's getting ready to top.
Party's over.
It's when I was at Dean Witter, we knew that if we bought out a sector fund, if our firm bought out a sector mutual fund, that was it. You could short with abandon. It was risk-free from there. It was going down, right? It didn't, if you had alchemy and we're turning lead into gold and Dean Witter did a fund based on that, it was going to stop working. So, and it's the same thing with the financial media and newsletter industry. If they are all hyping it, it's getting ready to go down. They're all hyping it right now. I saw one, it's like, nuclear energy is a big part of the future. You need to buy these nuclear utilities. Okay, that's like goes down as some of the worst advice ever. Because we've built one plant in the last 30 some years. It was permitted in 2009. It's running, I believe Volga came in at 5 times original projected costs. And it just came online. Now, permitted in 2009. So there's a process, right? And the people that are going to spend this money are going to be the utilities. So they're not going to get any big nuclear boost to their earnings. They're going to have to spend a lot of money for the nuclear revolution to happen. So why would I want to buy the stocks here?
Right.
But now, Cameco, CCJ.
Okay.
You take a look at that. Earnings are up. Revenues are up. Analysts are scrambling to raise their estimates. The price is moving higher because institutional buying pressure is coming into the stock, right? It's not cheap. It's not undervalued. You've got to look at this kind of like William O'Neill did and kind of like Louis Navellier does, that you're going to pick 10 stocks, you're going to make all your money on 2 of them. You're going to get stopped out of the rest of them. That's how momentum works. And so when Cameco coming off a bottom, you're going to sell off in the market and the stock's starting to move back up. You want to buy it. You want to have a pretty tight stop. And if you can stop that, just walk away for now. But that's how twin momentum works. Rising earnings, widening profit margin, analysts raising their estimates, margins getting better, and the stock outperforming the market. But you really want to see that smooth up into the right progression because, like biotech stocks that trade on hope for results in trials, they can be up, down, that's like crazy. And you're just buying stories. It's that smooth up into the right buying that's what you want to look for in a momentum stock. I think Wes in his book called it frog in the pan momentum.
Gotcha. And I think the key, right, is to get out as soon as that momentum fades, like to be very quick to sell out. Like William O'Neill, I know he was big on that. Like, I think 10% was the rule or something.
I think he used 7 or something like that. Yeah.
Gotcha.
But as soon as the momentum goes and the buying pressure stops, you got to be out. And some of them will just ride for a very long period of time. That, and my big interest in that is that I found most people can't do the deep value thing. And it is hard, right? Because when you're talking about, I own Friedman Industries, they make tubular pipes for the oil and gas industry. People look at you funny. That's not like saying, yeah, I own Amazon, or I own, Facebook or Meta, or, I own Nvidia. That's popular and everybody knows what it is, and you're a genius. And so you can talk about that around the water cooler at work. I'm assuming they still have water coolers at work. I don't know. When you talk about, I own First C Corp in Rhode Island, or I own Northeast Community Bank in White Plains, New York, people look at you like, yeah, well, who cares? And so it is kind of hard. And you own stocks for a very long period of time. And the one thing that you are not doing, you're not in front of the screen trading all day like a video game. And that's kind of, people like to do that. It's a very expensive hobby, but they like to do it. So we got interested in momentum just because we found so many people are not capable of actually doing the long-term patient investing thing. So what else works? And then I think I had dinner with Wes and Meb Faber one night in Orlando during a AAI convention. I drove by.
Awesome. That's an awesome dinner.
It was a great dinner. It really was. And they were both like, look, we're deep value guys. And that's the base of our philosophy. But if you're ignoring momentum and you're ignoring trends, you're making a mistake. I was like, oh, now wait a minute. These are two really smart guys, who don't work together and who I respect, and I've read their stuff and communicated with them. And they're both telling me the same thing, that, yes, this works, but you need to be aware of these as well. So that's just kind of the evolution of being exposed to other people and ideas. And then taking the most important thing that Victor Niederhofer ever taught me. If you hear an idea and you like it, test it. Don't ever just say, oh, that sounds great, let's go do that, because that's a great way to lose. And it's tempting because you hear a lot of great ideas and a lot of great stories. And I have a lot of great ideas, and I'll write them down on my pad and type emails to myself on my phone, and I'll be excited about it. I'm going to come in and I'll put them in the database and I'll crunch the numbers, and you get the thing back that says you're a moron for even thinking about this. And then you move on to the next one.
That's true. Yeah. And I find that a lot of times when you think something sounds like it should work, you go back and test it, and it doesn't. I find that a lot myself. And I think that's good advice to test your ideas.
Right. Or either it's like when I was in the 80s, when I was coming up, risk arbitrage was massively popular. Okay. Mm-hmm. And, I later had a talk with Guy Weiser Pratt in New York. I met him, and he said, look, we would not look at a deal. Wouldn't touch a deal unless we had a 30% raw spread. Okay, now that, since a deal back then would close in 4 to 6 months, right, you're probably, 60% annualized return, 50, 60% annualized return. Then they levered that sucker 8-1. Okay, that's how Prud'homme stayed in business when Guy Weiser Pratt was running the desk. At the time, it's where Robert Rubin made all his money. Mm-hmm. Carl Icahn came up to that. I mean, Warren Buffett was a big player. The risk arb industry of the 70s and 80s gave birth to a lot of the modern value investors. But anyway, it was wildly popular because the returns were massive.
Okay.
But massive returns attract massive capital.
And then that ruins it.
Right. It doesn't totally ruin it, because you could still do risk arb, and risk arb is treasuries plus about 200 basis points. Mm-hmm. So right now it's not a bad business. You're probably getting 6-7% on a raw basis. You can lever it up and annualize it a little bit more, but it ain't 50 annualized with no leverage. So, a lot of things that are great and did work stop working. So, and you need to be aware that this happens.
Yeah, and you have to be able to adapt to that.
Right.
Interesting. So you were talking about testing your ideas, and I get the impression that you're very quantitatively oriented now. Were you always so quantitatively oriented? And if not, like, what kind of drew you to that approach?
There's always been a quantitative element, because there's a quantitative element to deep value. Back when I started, and the professor in the office taught me, you had the Standard & Poor's stock guide, which is gray booklet that came to your brokerage office every week in the mail. So mailman bought it in and delivered a bunch of copies, and you'd go through it with a highlighter. because it had all the information and ratios in it, right? There was no just popping on your screen or go boom on Yahoo and getting a whole list of stocks. So you had to kind of go through it and highlight them. And then once you were done highlight them, you'd go up and you'd get the Standard & Poor's stock guide from the front of the office and you'd go through them. Now, that's still quantitative because you were looking for just a couple of numbers, right? You were looking for PE and you were looking for price to tangible book. And that's kind of where you were going. And then you'd start doing the background, whether you're using the S&P or the value line or whatever you used to get deeper detail. But it started quantitatively. And then, if you ever read Graham's last interview, he said that, look, we used to do this with the nets, but there's not many of them anymore.
Mm-hmm.
And I think this was 74, 75.
The low PE method he developed then.
He developed low PE, and it was totally just quantitative. And there were two interviews. One, he talked about low PE. Like 6 months later, he did another one. He talked about low price to book value. But it was both the same thing. Quantitative, strong balance sheets, more debt than equity, stable dividend payments over a long period of time, and stable valuations and profitable on both sides. And just that quantitative approach just crushed the market. And I kind of figured out that was the way that it was going to go. So yes, still very quantitative, very much. And I was fortunate to meet Victor Niederhofer, who is the least value-oriented investor of all. Well, he's not an investor, he's a trader, probably the best futures trader ever, but he's also had two of the most spectacular blow-ups ever. But a brilliant guy. And he really kind of took me in a direction that was more quantitative than just purely qualitative. Now, I do still love distressed and I love fixed income, and it's much harder to do those purely quantitatively, but equities, actually it's a preferred approach because you get some, I don't like that company, I don't like that business. You get your biases out of it because you're only relying on numbers, and you don't realize how many biases that you actually have until you buy a purely quantitative portfolio and realize that you're not a big fan of any of the businesses, but the stocks are so cheap, you're going to go ahead and buy it.
Yeah, I hear you. Yeah. And I guess your early experience with that daycare, that's a pretty good example of where getting too caught up in the qualitative elements can kind of lead you astray.
Right. Because that's the perfect qualitative story, right? I mean, and we've seen a lot of those over the years where the story is just fantastic, but something goes wrong or it's just a story, the numbers don't support it, and there's no margin of safety. So you can get caught up in these great, fantastic stories that just have unhappy endings and you don't see them coming. A quantitative approach that incorporates credit, you tend to build in a much bigger margin of safety. So volatility becomes your friend, not your enemy.
Gotcha. Yeah, that makes sense. And so you mentioned like the Ben Graham, like low PE, good balance sheet strategy. So what are some of your favorite quantitative strategies like that one?
And again, we credit score everything. All right. So we're going to take a list, and my favorite is price to tangible book. Always has been, always will be. I love stuff that you can convert to cash, real estate, cash, securities, scrap metal. I don't care what it is. If I can convert it to cash at reasonable price, then I add it all up. If I can buy the business for less than that, and very important, they're generating cash. The fundamentals of the business are good. They're earning a positive return on assets. Business is getting a little bit better, not a lot worse. And most importantly of all, they pass a credit check. And we're really strict on that. They've got to have what it takes to stay in business and keep the doors open.
Gotcha. You know what's funny about price to book? So like I first started getting interested in this stuff like 10 years ago, and everything you read was like price to book doesn't work. But if you test it over the last 10 years, price to book has beat like all the other multiples that are out there, which is funny.
Here's what price to book has going for it for the most part. Okay. Price to tangible book, you're going to end up with smaller companies, except at the bottom of big bear markets when a whole bunch of stuff. So I'm excluding banks here for right now and most financials, but you're going to end up with smaller companies, and you're just not competing against the multi-billion-dollar funds. There's no point in them coming down and doing that. So you're playing in this obscure, less liquid corner of the market, which is exactly where Charlie Munger spent the last 10 years of his life telling you to be. I mean, at every single daily journal in Berkshire meeting, at some point, Munger would say, look, we couldn't do this again. You can't do this with this much money. There's too much money and too many eyeballs. If you really want to earn high returns like we did, you've got to go to these obscure, less liquid, less efficient corners of the market, or you can't do it because you're not going to have the same tailwinds. So that tends to, low price to book, you're going to be in areas where not too many other people are, except after a big crash like 2009. I mean, some incredible businesses traded for less than price to book, and it was a massive opportunity. But low price to book, good credit, over time, you're going to beat the market.
Awesome. So you mentioned, I think you use price to tangible book a lot that's really the focus for the small banks. So for the small banks, kind of what drew you into that, and what are some of your strategies that you use with small banks?
Okay. When I left the West Coast and I came back to Annapolis, Maryland, I went with a small regional firm, and they made market in a lot of bank stocks, and they were a big player in Maryland, Virginia, Delaware, Pennsylvania, tax-free bonds. That was kind of what the firm did. And we had a guy in the office, and he's a great guy, just passed away a few years ago. But his knowledge of the stock market was not great. He didn't know a lot. And he came in every morning at about 9:27, just before the market opened. He was the last known practitioner of the 3 martini lunch, and he was at happy hour by about 4:20 every day. Guy made a fortune, right? Had the big house downtown on the creek, and another house on an island in the Chesapeake Bay. He was crushing it. And so I asked another guy, and I said, what the hell? How is he doing that? I'm in here working until 8 o'clock at night. This guy's out of here in no time, and he's making all this money. He was trading exclusively small bank stocks. And because he'd been a lawyer in town, he knew everybody in town, every business in town. He knew every owner of pretty much every share of every small bank. And he just made his living crossing bank stocks, illiquid bank stocks, from buyer to seller. This was prior to Regulation FD, so we could mark those suckers up as big as we wanted. So if we had a stock trading 5 bid, 6 offered, we could buy it at 5 and put it out at 6 and keep the whole 20%.
Wow. Okay.
Yeah. And it was cool because here's the thing, right? We were doing that transaction. This is in the environment not too far after the S&L crisis, right? So small banks are trading at half a book.
Oh, okay. Cool.
So we're getting massively paid and still putting the stock out at, 55, 60% a book. Clients end up loving us because they all get taken over within 4 or 5 years, right? Especially after Clinton signs the Regal Act in 1994, where takeovers just explode and everything's getting bought. So we're making money. The firm's making money. The clients are making massive amounts of money. So this is one of the few times in your life where you'll see a 3-way business transaction where everybody's walking around feeling like they made a ton of cash. But as you continue doing it, I begin to see there's real value in this because the consolidation trend started under Reagan, really caught fire under Clinton in 1994. But when this thing started, we had 18,000 banks plus credit unions. Okay. Wow. For comparison, France has 400. Okay. We have more banks than the entire EU.
Wow. Okay.
Okay.
And that's really a result of Glass-Steagall, right? Like, we really restricted in the 30s. We really restricted the ability.
Yes, and you had no interstate banking.
Yeah.
Okay, none. And for years, until the last decade or so, if you had a group of business people in a town and you got together and you raised the 25 million or whatever the de novo minimum is now, you could look then say, okay, 5 years out, I'm going to be earning an eternal 15% return on equity on my money. Right. And we're going to be able to leverage 10 to 1. And we know who all the developers and players are and every scrap of land in town. So it's going to be really hard for us to lose money. And that really changed with the great financial crisis, obviously, because bankers got stupid and just kind of changed the whole landscape of things. But right up until then, starting a bank was smart. And you were going to make money as long as you didn't screw up real bad in those first 4 or 5 years. Today, that economic incentive doesn't necessarily exist in most situations because getting to that 15% ROE today requires massive scale,
Gotcha.
right?
Okay.
Because it's, growing regulatory costs, they go up every year. That's what regulatory bodies do, they grow. But then the big thing is technology. And this accelerated because we adopted stuff we didn't expect to see for a decade got adopted during COVID.
Like work
Okay.
from home, you mean?
Work from home, bank from home, a whole bunch of stuff just it really accelerated. And so your technology spend hockey sticked. And when your technology spend hockey sticks, so do your cybersecurity costs.
Mm.
So you've got these, two branch banks. The board is 60, 65, 70 years of average age. The founders have a lot of stocks. There's an employee sub, so employees have a lot of stock. Everybody's getting older. You're looking for a door. It's really hard to turn a profit now because of these climbing costs. So what are you going to do? You're going to start looking to sell the bank. Where ordinarily that would mean you're going to sell the bank cheap, except we live in a world where the economy might grow 2%. Okay. And if you get to the other side of all the current madness and inflation, so we get inflation back under control, and you look at what the Fed's projecting out long term, 2%, right? What was it prior to that? In spite of political claims to the other, 2 to 3%. It's been pretty, we're a massive economy, guys. I mean, it's really, really hard for us to grow consistently at 4, 5, 6% like we did in the 50s, 60s. We're too big. And even with AI, for every productivity increase we get from AI, it's going to destroy an industry.
Probably true,
it's just like the internet did. So there's going to be a balance there. It will grow, but it's not going to be at a massively quick rate. So now I'm a publicly traded bank. I have to grow my earnings each and every year, or the analysts will hate me, the investors will hate me, everybody will hate me. I will hate me because my stock won't go up. So how do I grow my earnings in a 2% economy? I buy a smaller bank. I can buy a smaller bank, wipe out 30, 35% of the costs. Now, if I'm earning a 2% ROA and this bank is earning a 25 basis point ROA, which is a very common transaction. Okay, so I'm going to wipe out 35% of costs, plus the ROA on the assets that I'm buying is going to come up. So I'm going to make massive money by doing an intelligent acquisition on this bank. I'm really going to add a lot of money to my bottom line relative to the assets that I'm buying. So the best way to grow your bank, and if you look at Bank OZK, at Home Bank shares, at the banks with the really high earnings growth, Western Alliance, they are serial acquirers of other banks.
Gotcha.
And so you've got a willing pool of sellers and a willing pool of bankers. The sellers need to sell. The buyers need to buy. Sometimes, as we did it a few years ago, right after COVID, you get way apart on the price. But then it comes back together and everybody gets a reality check. Even this administration, post the 2023 carefully manufactured banking crisis, is starting to look and say, we need healthy bank M&A. Healthy bank M&A. The rhetoric has always been, well, it's bad for the consumer. It may be good for the investor, for the banker, but it's bad for the consumer. The truth is it's not bad for the consumer. Generally, the consumer will get the same or better product offerings. But you look at the small town and the rural banks, there's only one way for these banks to survive. And that's to get bought or that town goes bankless.
Gotcha. And your goal primarily is to buy small banks prior to getting bought out, right? Like your hope is like, I'm going to buy them cheap and then eventually a larger bank will come in and acquire them.
Yeah. I mean, buying a small bank is almost like buying it's almost like selling a put on a large serial acquiring bank. But yeah, that's exactly right. We're looking to buy the smaller banks run by, people who are not doing stupid things. They're good, solid bankers. It's a good bank, but it's really tough for them to gain the scale. Now, one of two things is going to happen. As long as they don't start doing stupid things, okay, they are either going to find a way to grow that bank to the point where they get the scale they need to grow the bank, to grow the share price, or they're going to sell the bank. Either one of those is a good outcome for me. Now, what makes this super attractive to me is nobody really does this. And I could talk about it, and I can show you, that it's been over a decade since we closed a losing position in a bank stock. And that's like not a joke. Yes, we've had some go down first, really only closed them on takeovers. And it's ridiculously and wildly profitable, but it's boring.
And it's probably not as scalable, right? So that's probably why you don't hear as much about it, right?
No, it's not scalable.
Right.
I mean, if you could probably do, a few $1 million. If you had the right brokers, you could do a few $1 million. You know, a lot of banks. But can you do this with a $1 billion fund? No, you can't. This is not the 1970s anymore. And it's, you know, you got to be a little bit more selective and careful. And it volatility is your friend here, because like in last year when we had and I call it the carefully manufactured banking crisis, because it wasn't a banking crisis.
Yeah. So tell me a little bit about that. So, like, you know, I remember. So we're talking about SVB went under. It was this big. They had this big tech base. It kind of seemed to me like a bunch of BS at the time. But you said it was. So, what's your perspective on that whole thing?
Okay, look, and again, remember what I said about bankers doing stupid things?
Yeah. Yeah.
Every bank in this, all four of them were doing stupid things, but let's take Silicon Valley Bank shares, because this is a bank that blew it in a way that it's going to be a Harvard MBA study course, okay? Because these guys had a lock on venture capital banking with a huge portion of Silicon Valley Bank. This stock had been such a massive winner from the 1990s on. I bought the stock in the 1990s at $15, right? Sold it at 45, considered myself a freaking genius. That stock went to 600. So these guys had a lock and they blew it 100%. They believed the Fed when they said that inflation was transition and, you know, rates were going to stay longer. There were going to be no rate cuts, rate increases before 2025. You can't believe anybody that makes interest rate forecasts. Henry Kaufman nailed that one after his spectacularly accurate forecast on markets back in the 1980s. They said, well, what's going to happen next? He said, I got lucky. So there was too much. We didn't know what was going to happen when we tried to reignite the economy. Nobody did. They went out and they bought a lot of longer term treasuries with 2% or lower coupons. They bought a lot of very low coupon mortgage backed securities. And they had, at one point, 95% of their deposits were uninsured. They believed their own marketing approach, that they really thought people were going to stay with them. And by the way, First Republic and Signature had the same problem. They thought they were so good and they had built up such a loyal client base that no matter what, their customers would stay even with uninsured deposits. Well, they didn't stay. But so we've got Silicon Valley Bank has made a mess of things. They're, you know, and friend tells of being on a shuttle going to a conference in Reno, a VC conference, when everybody's phones lit up. And it was their backers, their VC bankers calling us saying, get your money out of SIVB now, because we don't think they're going to make it. Mm-hmm. So that was on a Friday afternoon. Had it been 20 years ago, Silicon Valley Bank probably made it, because they would have been able to do a lot of things to hold on to the deposits over the weekend, sell some stuff, reliquify the banks. But this came into play. So they were on the shuttle, moving millions of dollars going into the conference. And that played a huge role in everything that happened at all four banks. However, the immediate, you know, the instant experts and clickbait hunters and media came out and they're like, oh my God, this is going to be an epic crisis. It's a banking crisis. And the only things that are going to survive are the too big to fail banks. So you got to get all your money out of these little tiny banks, and you got to get them into the too big to fail banks, because these guys are all going broke. Mm-hmm. And I said, oh, this sounds terrible. So I called a few bankers. Like, yeah, we had a couple guys call. We just thought what was going on. They went back to the golf course. And so I called a couple guys I know that also do this, and I called some hedge funds, some activists. I was like, what are you seeing? They said, well, we were worried. So we made a whole bunch of calls, and nobody's worried. They're not getting calls. Nobody's really care. The call comes in. Hey, am I covered? Yeah, you're covered. Did you do any of that stupid stuff? No, we didn't do that stupid stuff. Okay. So there was never any big exodus out of the small banks. And, you know, we get the H8 every Friday afternoon. You're looking at it. Well, hell, deposits are the same as last week. Let's go back to sleep. But if you looked on Twitter, the world was ending.
The world's always ending on Twitter.
Yeah, the world is always ending on Twitter, correct. And everybody was telling you, you know, one guy, I'm going to leave him nameless, but he came out and he's, Bank of America is going to fail because they've got hundreds of millions of dollars or hundreds of billions of dollars of securities, and they're going to all go down in value. And it's like, you understand nothing about banking at all. Because yep, they went down, but as long as they don't sell them, they're not taking a mark for regulatory purposes. And oh, by the way, they have $2 trillion in assets.
Yeah.
So this is like, it's like getting stung by a bee. Unless you're allergic, you're not going to die. And Bank of America was not allergic. They plenty of revenues. And by the way, I say this as somebody who truly, from the bottom of my heart, detests Bank of America, but they were never going anywhere. And
Right.
all the small banks were like, God, would y'all stop? Leave us alone. There's nothing wrong. So you had all these small banks with lots of capital, and that's always the key in these things, right? You can quantitatively bring all small banking down to equity to assets ratio, price to tangible book value, and non-performing assets. If you can mark them properly on those three, you almost don't need to know anything else. Non-performing assets will give you the sell signal to get out every single time. Price to tangible book, like 2007, there were like no banks at price to tangible book anymore. Deals multiples had gone from 1.5 to there were deals getting done at 3 times tangible. It was fun, by the way, but there was nothing left to buy. So as you were getting banks taken over, you just added to cash.
Gotcha. Okay.
So you can do it quantitatively with just those three numbers. But when you looked at the banking industry as a whole, and this has gone on from that mini crisis to today, none of the things they told you was going to happen was going to happen.
Right.
If there's a bank out there that has lots of AOCI losses, accumulated other comprehensive income, they've got lots of long dated, low coupon securities, and the equity to assets is under 7. They're in trouble.
Okay.
I think there's 6 or 7 of them. I mean, there's just not a lot of them. Everybody kind of post financial crisis. Everybody that came through it has kind of maintained decent capital levels. They've been careful. A lot of banks that had excess capital went ahead and they reworked. They took the loss on securities and reinvested it at higher coupons to increase cash flows coming in. So if you had plenty of capital coming into this and you weren't a complete moron about your securities positions, you're fine. And the credit, and we hear this every day, the banks have all the office loans. You've heard this one, right?
Mm-hmm.
Banks have all the office loans. They have all the commercial real estate. It's all in the small banks. No, it's not. First off, you need to understand that the problem in commercial real estate is offices.
Right.
Okay. The problem in offices is central business district office properties in major cities. That's the major problem. Separate one more time. It's not the Class A properties. It's the B and the C. And by the way, it's just up in Boston, and at nighttime you can see this in the skyline.
Okay.
Okay. It's the B and C, the older buildings, they've got holes, right? The Class A buildings, they're full, like Vornado Real Estate, VNO, all Class A in New York City. New York City is, nightmare stories about New York City. It's an 80% occupancy rate there. It's terrible. Vornado's 91% occupied.
Ah, okay.
Okay. So it's Class B and C, mainly central business district, big cities. Community banks have exactly, I don't want to say exactly 0, but it's really, really, really close to 0.
Yeah.
Their office loans tend to be on 4-story office buildings in the middle of nowhere, Indiana. And I'm just picking on Indiana here. I'm picking anywhere.
Gotcha.
And it's doctors, it's lawyers, it's mortgage brokers, it's stockbrokers, it's local businesses, it's district headquarters for out-of-town companies. Look, when they weren't supposed to be going to work, they were going to work. Right? Those businesses were always full. Okay.
Yeah.
So there's going to be a reset of the loan. That's a fact. And it's going to go up. And the landlord's going to take it. And they're going to go, well, I ain't paying that. And they're going to give it to the tenant. The tenant's going to say, okay, well, I'm not going to pay as little of this as possible. So let me pass this on to the customer. That's why we've had services inflation, by the way, very sticky services inflation. But the business, most of those loans are not going to fail.
Yeah.
And then credit card loans are ticking up, but most of it's ticking up outside the industry.
And
So-
most of those loans are probably businesses, it sounds like, where they kind of need an office space. Like if you're a lawyer, you need to have some space to
Yeah.
have a meeting with your clients every once in a while. So they're not just going to pack up and go fully digital.
No, and it's showing up in the earnings reports that come in, which nobody reads, I think, but me and a couple guys I know in Arlington, Virginia. They read them. I know that. But it's kind of funny that nobody seems to be paying attention. Everybody's watching the headlines and ignoring the fact that everybody's reporting that everything's okay. And it's really early on, you could sort out who's got a problem and who doesn't. And the problem list was just really small. And then again, quantitatively, if the NPA non-performing assets go over a certain threshold, just sell the bank.
Gotcha. Cool. And so when you're talking about small banks, like how small are we specifically talking about?
Small. I if they fit my criteria,
Yeah.
I've owned banks down to a $5 million market cap.
Oh, wow. Okay.
And look, I don't trade bank stocks. I've lost track how many I own, but I promise you, I do not trade bank stocks. I buy banks, and there's a difference. I intend to own these banks until something happens. There's some reason to sell. Most of the time, that is a takeover. There has been an isolated instances where there were massive buybacks done that took the price up over, because I do have an upper limit where I'm like, nah, I'm gone. I don't, this could be the best bank. This could be the best bank in history. I'm out. And that's never, now one time that's cost me money. One time where the bank just kept going and going and going and going. Every other time they've kind of came back into reasonable. So I'm not looking to trade around it. I'm not going to trade a few shares when it's up or anything like that. When prices are down and these banks fit my criteria, and I love to buy when people are panicking. Okay. Like last year, and I did a thing for the Money Show. I mean, I was literally pounding on the desk. I did a video for them, hollering, buy banks now. Whatever you do, stop, forget everything else, buy banks. They're too cheap. Buy real estate. You got to buy it. The people that listened to me did really, really well with that. So but you got to have that mindset. If you're looking to trade, forget it. It's not gonna, you don't want to be in it.
So you also do thrift conversions, right? With banks. Do you want to talk a little bit about that?
I love thrift conversions now. Unfortunately, more and more people have found out how thrift conversions work. But again, a lot of people don't do it. Now, I've discovered thrift conversions through my friend, the professor, but then what really drove this home as to how profitable it is. And I'll get into the mechanics of this in a second. But when Peter Lynch ran the Magellan Fund, one of the most famous stories ever, 12 years running that fund, 29% a year. That's no leverage, by the way, folks. That's like incredible. He didn't even buy options based on a magic pattern, nothing, just pick stocks. He was a big player in thrift conversions. And they had accounts in every thrift all over the United States. So because when a thrift goes public, the first option goes to depositors to buy stock on the IPO. So Seth Klarman had those accounts, still does. But Peter Lynch and Fidelity Magellan, they had accounts all over the country. So did Michael Price, the guys at Tweedy Brown. Just lots of value guys had it, because here's what happens. Okay. Under the Thrift Act, you're taking in deposits. You're making mostly single family mortgage loans. Okay. If you want to expand, now you can't just be a mutual thrift anymore. Mutual thrifts are owned by depositors. So you create a mutual holding company, you go public. Now, the way this works is we're going to have a $100 million bank with 10 million shares. So stock's worth $10. Okay. So 100 million bank, $10 a share. We're going to do the IPO at $10. And everybody's going to buy it. The depositors are going to buy other stock almost 100% of the time. So now I've got 100 million in assets, right? But now I just sold $100 million worth of stock at $10 a share. So now I've got 200 million in assets. Still only got 10 million shares. IPO buyer, my stock at 10 is now at 20. So it's instant bang free money. And does the stock trade to 20? It does not. And is the math that clean? No, it's really not. But it's usually you end up with a book somewhere 16, $17 in today's market, the way because they use various ratios to adjust stock prices and that sort of thing. But so you'll pay 10, the book's 16, 17, $18. The stock will trade to 12 or 13. Now, you cannot but pay a dividend or buy back stock without the approval of the Fed for a year from the date of your offering. Some of them turn into absolute buyback machines, because at this point, you were a small, well-established mutual thrift. Maybe there's been some larger ones, but for the most part, they're small to mid-sized banks. You were a mutual thrift. You were very conservative, owned by depositors. You had a lot of capital anyway. Now you have a lot of capital squared. So a lot of them, and William Penn is a great example, they bought back 30% of their stock last year. So, yeah. So they just turned into buyback machines, doing 5% buyback after buyback after buyback after buyback until there's a change of control restriction for 3 years. Can't sell the bank for 3 years without the approval of the Fed. Fed's not giving you approval. So there you can buy back stock, you can pay a dividend, but you can't sell your bank for 3 years. Well, at about the 5 year mark, most of these banks tend to be sold. A lot of these conversions are done as liquidity events, right? We're the founders of this thing, or we're the sons of the founders or the grandchildren of the founders. We own a lot of stock. Our family and friends have a lot of stock. There's only one way to get out of what we own in this bank. That's to do a thrift conversion and eventually sell it down the road. Some of them, ESSA come to mind, Hometown Bank Shares down in North Carolina. They intend to grow the bank and they use the capital to grow. But thrift conversions down the road tend to get sold. We look at them at the initial trade. If it trades cheap enough, I'll buy some there. In this environment, we've been waiting a year or two. I keep a running list, because we've had a lot of volatility. And as they get closer to the end of the 3 year conversion, we'll buy them. But generally speaking, when the conversion is done, you have this small bank with a super clean loan portfolio with an enormous amount of capital that more than half the time is actively looking for an exit strategy over the next couple of years. So look, I don't, myths and dreams are wonderful, but Wall Street averages about 10% a year. And it's actually a little bit less than that over the long run. So if I can buy a stock at 70% a book and sell that thing for, close to half what I paid for it anytime in the next 5 years, I'm a pretty happy camper. And if I can do it over and over and over and over and over, well, I'm a very happy camper.
Gotcha. Yeah, makes a ton of sense. And do you want to talk a little bit about the opportunity set, like in small banks, that existed a year ago? Because just looking at the ETF representing small regional banks, it's up 50% in the last year. So it must have been a bonanza in that period, right?
It really was a bonanza, and everything was on sale. And you looked and you saw the first quarter earnings reports came in. These are coming in, in April and in May. And you're looking at them and going, okay, where's the disaster? It's not here. But everybody had dumped bank stocks because the internet said to dump bank stocks. And I am appalled that this is true. But when the internet says to do something, people do it. It's a little terrifying when I think about it in those terms. But so banks were just ridiculously cheap. You had high quality banks earning, very nice returns on capital and equity with lots of capital, trading at 70% a book. You can buy that bank all day. Nothing bad is going to happen. And we did, and nothing bad happened, and a lot of great stuff happened, and there were some mergers, and the bank preferred stocks were another massive opportunity because they got crushed because everybody was just so sure the banks were going out of business. So you'd have $25 par preferreds trading back down at $18, $19 with 8% yields that have now traded back up to 23, 24 and still paying the yield.
Very cool. Yeah. So you mentioned preferred stock. So how do you use preferred stock in your portfolio? How do you approach preferred stock? It's not something you hear a ton about. So I was very curious how you apply that.
It's fixed income to me. It's bond substitute for the most part. Like in Vornado, for instance, Realty, we are super ridiculously bullish on this particular New York City-based real estate investment trust because it is all Class A properties, because they have a triple B credit rating, because they are 91% occupied, because lots of reasons. So the preferred stock, it's $25 preferred, 4 and change coupon. It's trading at 13 and change. This is the preferred O with an 8.5% yield. Par is 25. Now, unless interest rates go way back down, we're not going back to 25 just on interest rate movements. Okay. However, anything that happens here, whether it's dramatic improvements in New York City real estate, a corporate transaction that the market views favorably, or Fed interest rate cuts, anything happens, or credit upgrades, any good news, this thing goes screaming back towards par, maybe down to a 6% yield. Okay. But my yield's not changing. I've locked in 8.5 pretty much forever. So got 8.5%. I've got lots of upside. My downside has to be New York City real estate gets so bad the Class A properties are in trouble. If New York City gets bad enough that the Class A properties are in trouble, it's going to be like interest rates going back to 1%. We're not going to be worried about our stock portfolio. We're going to have much bigger problems.
Yeah.
So I don't see that as a significant risk. I do not see interest rates going higher as a significant risk. Even if the Fed wanted to, they can't for a whole bunch of political and budget reasons. Raising interest rates in here would be devastating to the U.S. credit rating and standing in the world. So that's not happening from here. So I got all these good things that could happen, very little downside. And I'm standing just a cut below the bondholders. So I'm actually in a really good shape if they actually liquidated the damn thing.
Awesome. And I know you're also bullish on mortgage companies. So why are mortgage companies a good opportunity right now?
Okay, well, it's not so much, it's not the mortgage originators. That's
Gotcha.
we're watching that because it's a tough business right now.
Yeah.
It's, mortgage rates have spiked. Housing affordability's gone absolutely bonkers.
Mhm.
Okay. Which means that origination is down. And if you're making your money on origination fees, you got a problem. But the mortgage investment firms, the REITs, okay, the agency mortgage REITs, and I love this because everybody hates them. Nobody understands them. It's work to kind of get what's going on with these things and the way the spreads work. But when you get down and you get into the nuts and bolts of these things, it's not been pretty because with rates going up, they've been getting hit. But we've got a market where the spreads have blown out to historic levels between what you're borrowing at and what you're lending at, basically. Okay. There are 2 standard deviations wide, and the biggest buyers in that market are out. The Fed was the biggest buyer. They're out. They're letting stuff roll off. Okay. And they're not, throwing that, 10 billion or whatever it was a month back into it. Banks have really, really pulled back from this marketplace. And the reason was the credit crisis, COVID, everything that came out of that. And then the insistence that we have new capital levels and we reset the Basel III numbers. So there was Michael Barr's original proposal is, take all the money the bank ever had and put it in. You got to hold that as capital or something. There was a dramatic increase in capital levels. Well, that increases more than European and Asian banks did by about 20%. Put U.S. larger banks at this huge disadvantage. That ain't happening. Looked like it was there for a while. But in his press conference up on Capitol Hill, or congressional hearing, not press conference, Powell said, look, we're going to repropose the Basel III regulations. We're not comfortable with these. If you'd had a camera on Michael Barr, you would have seen him say bad words, guarantee, because that was the death of that proposal, and he had to know it at the time. So the capital levels are not as restrictive. They can start to loosen up a little bit and come back. But the Fed and the banks have really been out of the mortgage-backed securities market, leaving the agency REITs as buyers of last resort to a very, very big extent. So they've been getting favorable pricing. Now, one of the biggest risks in mortgage-backed securities is repayment risk, right? Rates go down, you get repaid. What you thought was a 6% coupon for 30 years is now paid off, and you made 2. So that's a problem in mortgage-backed securities. However, there's no repayment risk. There's almost no prepayment risk in the mortgage market right now. Most of what was issued is 4% or less over the last decade. You can't refi it, so prepayment's really not on the table for much of this stuff. So your models are a lot more accurate than they ever were. So you've got these things sitting here, there's spreads. The spreads are hedged off, so you don't have the risk of rising interest rates. You've got a mid-teens ROE, all of which is being paid out to us as shareholders. Book values have stabilized for the first time in several years. So my favorite AGNC or Annaly and LY, you could sit here and you collected 14, 15% cash yields, and they're good. They can keep paying them for an extended period of time. Stock price will go all over the place in the meantime based on emotions and a whole bunch of stuff. And you buy more on down days and you just accumulate this stuff. And if your index fund does 15% and outperforms this over the next 7 years, I'll tip my cap to you. But I don't think it's going to happen.
Yeah.
So Haley Basserman, they call him the convexity maven. He does some stuff for Simplify. He's been a bond kind of guy forever. He says, the single biggest opportunity in fixed income right now is mortgages. Now, speaking of which, I'll throw this out. If you're trying to do far more conservative and you want to park money, but you want to lock it, right? Because if you park money in money markets and the Fed starts lowering rates, yield comes down, right?
Yeah.
Well, Simplified does have an ETF. The symbol is MTBA. They only buy current coupons, right? What is being issued right now, mortgage-backed securities. So there are no discounts. It's all current coupon income. So you're getting about 6% on this thing. And Fed lowers rates, the value of the mortgage holdings goes up. Your dividend's going to kind of stay about the same. So I'm not going to say it's going to be stable because the price is going to go up and down, but it is a pretty conservative way to just sit there and lock in better than money market yields.
Yeah.
So, and because you look at the 30-year end of the treasury market, there's no demand. So they're still sitting there at, like 4% and something. So that is a really good conservative play, but mortgage bonds, mortgage-backed securities themselves, I'm super bullish on those. And it's really hard not to be here. Housing prices are up. I know that the pundits are telling you they're going down. I can tell you I live in Southwest Florida and they ain't going down here. I mean, they may kind of like pull back and soften, but there will be no decline back towards the levels where these houses were bought just 2 or 3 years ago, which has taken the loan to value, by the way, in a lot of these mortgages that are owned by the mortgage REITs. They were done at 70% more loans to value. Well, they're like 40% loan to value now.
Gotcha.
Because the price has gone up so much. So there's just all this embedded equity. There's no rush of anybody to sell. You got over half of all homeowners are older than me, or 55 or older, so my age and up. And over 50% of all mortgages existing are under 4%. So no prepayment. You're just going to sit there, clip coupons. Yes, the mortgage REITs are levered. They're highly levered. They're also completely hedged. AG&C in particular has been Annaly. They've both been around a very long time. It's all agency backed, so you have zero credit risk. And it's just spitting out 14, 15% regular monthly dividends rolling through. So yes, really ridiculously crazy bullish on those. We are watching very carefully the originators. It's going to take some time, not for mortgage rates to go down. They're going to go down a little bit when the Fed lowers, but we're not going back to 3.
Right.
But there's an acceptance. And my son actually had to deal with this because at 3, they could buy Mansion X. Well, now they could buy not Mansion Y. So because the payment has literally doubled on a first-time buyer home.
Yeah.
So that's still kind of a tough business. The survivors here, and Rocket will probably be one of those. And I'd have to really do some more work on it. But the survivors are going to be great growth stocks. Fantastic growth stocks.
Because the worst is over, right?
Once we get a feeling that, okay, this is it, Templeton's point of maximum pessimism, and we're not quite there yet.
Okay. Gotcha. So you mentioned real estate. So yeah, it's a tough situation. So I think a lot of people have fresh memories of 2008 and they think like, oh my God, we're having another mid-2000s housing bubble. It's going to collapse. I'm not sure if that's the case. I mean, you have I think a huge number of mortgages in America are already paid off. They don't have the risky mortgages that they had before. So, but at the same time, the affordability is so out of whack. Like, I don't know. Where do you see it going? Like, I'm kind of on the fence.
Affordability only matters if you want to sell.
Yeah. Okay.
I mean, okay. You can't buy, which, by the way, is ridiculously super bullish for multifamily real estate, especially once again, Class A properties. Right? You can't move. You can't buy. There's affordability. There's mortgage issues. You can't buy what you want. So what are you going to do? Going to rent a nice place and stay there for a little bit.
Yeah.
So, and that's made us really bullish on multifamily real estate, both from a banking point of view and from an owning the REIT point of view. And again, we loved it because the misconception was there. And it's headline, we're building too many apartments. Well, okay, we're building too many apartments if affordability was what it was 2 years ago. That's true. And we built a lot of apartments, and in 2023, we delivered a lot of those. They filled right up because there was still excess demand from people that can't buy. Most of the stuff that was going to be built this year didn't get financed. The financing kind of backed away. So more single family real estate is still just massively bullish, as is single family lending right now. But on the home side, you don't have the leverage in the system. You don't have the stupid loans. Okay. So everybody's got plenty of equity. I mean, if you bought a house 3 years ago, anywhere around the coastal part of the United States, you have mad equity. So you're not underwater. The bank doesn't have so much leverage that they're going to be reluctant to work with you. Okay. So there's not enough leverage on the part of the homeowner. There's not enough leverage in the banking system or the lending markets. So you don't have the leverage for a 2008, 2009 scenario. For that to happen, like we saw in 2008, 2009, everybody's got to be over levered. I mean, that was a perfect storm of leverage gone bad.
Gotcha.
That doesn't exist. Could you see softening demand and maybe even a 10% decline in housing? Sure. Absolutely. It's happening in certain markets around the country. Is that a crisis? Not unless you have to sell, and nobody has to sell right now.
Right. Right. So a lot of those takes seem like they're just kind of like PTSD from 2008.
Right. Fighting the last war.
Yeah, yeah, yeah.
Very much. Yeah.
Gotcha. And so that's your view on real estate. So what's your view on the overall economy and macro environment?
The Fed's going to leave rates too high too long. They usually do. And we're going to get a slowdown. You're seeing some signs of it already. But look, I just flew from Southwest Florida up to Boston, rented a car, drove up to Maine, spent 4 days, came back to Boston. Okay. Every flight was full.
Mm.
Okay. And I'm full completely. The hotels were full. The tourist areas, we were in Maine at the beach, town was packed. So the economy's kind of grinding along in spite of some of the more dire forecasts that we've seen. And, people have been using, it's going to happen. It's going to happen. The Fed's going to go too far. We're going to have a recession, depression, and all this other stuff since COVID.
Yeah.
And here's my controversial opinion. Okay. This is the one that if we had an audience, they'd be throwing rocks at me. The Fed has actually done kind of a good job with this.
I agree.
It's we can talk what we want about the government spending because fiscal policy is a problem, a massive problem.
Yeah.
But we'll deal with that in a second. What the Fed has done is actually, they've done okay. And they've resisted political impulse to act too fast in either direction. There's a lot of pressure on them right now. I guarantee you to lower rates right now. There's going to be more if the polls are right. Come January. They resisted it. They haven't done it. That would be a huge mistake to do that right now. They also resisted the cries to go higher on rates last year. They were also almost as loud when people weren't satisfied with how fast inflation was going down.
Yeah.
So I think, and you can hate the Fed, you can want to audit the Fed, you can want to burn the Fed, you can want to do all sorts of terrible, nasty things to the Fed. It doesn't matter. The Fed is what we have to deal with. They have a massive influence on the markets. I think they've actually done a decent job here. And I think that, unemployment's ticking up, but not much. And remember that jump to 4.1, everybody's like, oh, unemployment's going up. You got to read the whole report. Yeah. Unemployment went up because we had a bunch of people come back to the workforce.
Yeah. Right.
Okay. It's not, are we creating tons of high paying jobs? No, not yet. But I hate all politicians, but the CHIPS Act was not a bad idea. Okay. That's actually going to create some pretty high paying jobs around the United States. So I think we're going to muddle through. I think we're going to be okay. It's just going to be the 1950s come back with, 5% growth? No. Are we going to be all right? Yeah, I think we are. And AI, I think, is going to be a net positive because I was skeptical as hell first. And I can tell you right now that, Chat GPT and Claude are one of the two first programs lit up on my computer in the morning.
Yeah. Yeah, it's pretty amazing. And I mean, I agree with you. The Fed has done a pretty good job. Like you think about Powell's whole term, like, okay, so he faced the pandemic. They were able to respond pretty aggressively to that. Out of that, we got 2 years of high-ish inflation, but like not really a big deal. Like you got 2 years of like 9%, compare that to the 70s. And then they were able to respond aggressively, get that down. And then on top of that, it didn't create the recession everybody would have thought. Like if you told people in 2021 interest rates are going to go up this high to like 5%, they would say, oh, there's going to be a huge recession. And like, we didn't have it. So I think they've navigated like a lot of the challenges of the last 5 years pretty well.
Yeah. And I think you have to weigh in as well that a lot of the inflation was, we broke the supply chain completely. And it was as much global fiscal policy as it was monetary policy. It was what the administrations did. And do you notice the S on the end of administrations there? Okay?
Yes.
The last two played in this. Okay?
I'm with you. Yeah.
Okay. So a lot of what they did was far more inflationary than what the Fed did.
Mm-hmm.
Okay. And had the Fed not acted, we'd be having a different conversation today because we would have seen some collapses. I mean, and I can say, look, I do real estate and I do banking, as a big part of what I do day to day. We own a lot of real estate and real estate securities. We own a lot of bank stocks. So we were talking to bankers, we were talking to building owners. We knew that, if all those businesses had been allowed to fail, the 1930s would have looked like a picnic.
Yes.
So you can go back and say, well, COVID wasn't that bad. And everybody forgets, and I get really angry about this one. We forget what we didn't know in April of 2020 because we didn't know anything.
Right.
And I wasn't listening to the internet or either political side. We're talking to doctors at Johns Hopkins, to epidemiologists at Stanford, to the virologists, using some context. My sister worked in the medical field, and people that I've met in my, very long career since I was started when I was 12 or 6 or however old. It was very young when I started, folks. And, they were all universal. We don't know. And the people working in ERs were terrified.
Yeah.
And we didn't know how contagious it was. We did not know what the death rate was going to be, how hard it was going to be to contain. So the steps that were taken had to be taken. And had they not, we'd have had a much bigger crisis. So I think the Fed's done a hell of a job. And I always remind people, look, it's the worst $200,000 a year job in America because that's all Jerome Powell makes.
That's true. That's true.
I think that, when Janet Yellen had the job, I think she really, was upset with herself for not getting the philosophy degree and maybe teaching, philosophy at a nice college up in upstate New England. And Jerome Powell has to wish he was back in private equity. He has to cross his mind every day.
Yeah, it's kind of thankless. Like, even if you do a good job, and there's always people on both sides of the table who are mad at you. Like, there's always people who are like, interest rates are too low, and there's always people like, interest rates are too high. And yeah, and no matter what you do, like, you're gonna have a ton of critics, and it's really hard to kind of get through and do the right thing.
It's a tough job, and I think we're here. We have about a 4% unemployment rate. Consumer spending is still it's pretty stable. I think that the lower end of the economy is. Yes, that we're starting to see some pain point down there, and that's mainly a function of higher prices.
Yeah.
But generally speaking, I think the U.S. economy is on a good track, and as long as we don't screw it up somehow, we're probably going to have a mild recession. I see it's going to be hard to sidestep that because we've just had such a long expansion, but I don't think it's going to be terrible. And I think we'll get through it and be just fine on the other side.
Very cool. So before we wrap up, I mean, what are some of the key investment resources that you use? Like, what are some newsletters, Twitter feeds, screening tools? What are some of the things that you would recommend people use?
Toby's acquires multiple. Must check. And, Johnny Hopkins there does a nice recap every week of all the articles and podcasts and everything that they see that they think are valuable. And I tend to agree with all of them. So I would absolutely be on their email list. West Grade Alpha Architect, they do a lot of research. You have to be a bit of a geek like me because it is academic research, but they do a phenomenal job. Where I'd really have to think about who I've got in my Twitter feed these days. There's so many. A lot of small bank Twitter. GuruFocus.com, if you're using for screening, is an invaluable resource. Just trying to think what else we use. I mean, I use so much. I try to, just read everything that I possibly can. I mean, every day we read the Wall Street Journal, we read Bloomberg. I also don't throw rocks, leave them in your pocket. I also read the Washington Post and the New York Times. I like to know every side of every argument. And it's also fun to see how bad, as a native of Baltimore and Annapolis, to see how bad the Washington sports teams are doing. That does make me feel good. That's kind of a boost. So Toby's, Wes's are absolutely, I think, mandatory reading. Meb Faber by the way, he has a new free email list called the Idea Farm. And he was charging $500 a year for it and getting it. And he decided to make it a free resource. Sign up for that one. And you can do it at mebfaber.com because it's just all this great research that he collects during the week and he sends it out once a week. But I mean, I think the key here is to just read everything, test everything. And on the small banking side, if you noticed, I'm being very protective of my resources. There's a reason. It's a small, tiny little playing field, and I'm going to keep it all for me.
I don't blame you.
To the greatest degree possible. But you had also asked, what do I think about stealing from super investors? That was one of the questions.
Yeah. Yeah. What do you think?
I want to touch on that because I love stealing ideas, right? I mean, I grew up on the Chesapeake Bay. I love pirates. I always feel like a pirate when I'm going through the 13 Fs and stealing ideas. But guys, you got to be smart about this, right? Bill Ackman's rate of return over the last decade has not been great. It's been, low teens at best. Carl Icahn, Carl's returns, most people can't handle the volatility. Carl eats it for breakfast along with a bottle of broken glass. So that's tough. Warren Buffett has lagged the market for 20 years now. So, do you do the headline super investors? No, you don't, because they have nothing in common with you. You want to look at some of the smaller funds. And the first place you always check when you go to the super investors, there is one group of investors that just smokes everybody else. I mean, it's not even close. They crush them. They kill them. And everybody thinks, well, they don't do a lot of public securities. But actually, the top investors on the public security side are the private equity funds.
Okay.
Okay. Now, sometimes this is a function of they did an IPO of one of their portfolio companies. They sold 20% of it to the market. They sold 20% to the market because they wanted to go up by 4 or 5x so they can stage an exit on the other 80%. Okay. But I always go to Apollo and KKR because these guys kill the market. Owning their top 10 positions as your core holdings, I mean, you would be doubling the market's rate of return over the last 20 years. And there's also incredibly valuable information. Like over the last couple of years, you've seen that their top holdings are not stocks right now. They're fixed income positions.
Okay.
There's a statement there.
Yeah.
Kind of, you just sit down and spend a little time thinking about it, and you'll see what the statement is. So there's a lot of information, and if you see them starting to concentrate in an industry, like that was, I'm always sort of bullish on energy anyway, just because looking out to the future, energy demand is going to go up, and everybody else wants you to pick a side. You either got to be renewable or you've got to be fossil fuel. I'm both.
It's gonna be a mix.
I'm both. If it's cheap and they produce energy, I want it. But when you saw all of the private equity firms rolling into the energy fields, it was time.
Yeah.
And and you could look and you would see these things trade 5 times free cash flow, discounts to asset value, and the big smart money's coming in. Well, it's time. So there's a lot of clues from them. So Apollo, KKR, Leonard Green, Blackstone, you can make money following their stock picks. There's also a lot of information in the reports.
Awesome.
Okay? And then I'm going to give you just a couple others here. These are on the financial side. FJ Capital. So my friends in Arlington I told you about. These guys came out of the wreckage of Friedman Billings Ramsey. When that was split up, Manny Friedman took his bank team and they went off. They started this fund. They're really good folks on the bank side, community and regional banks. And then Gator Capital, a fellow over in Tampa, Florida, doing just a phenomenal job on financial stocks, both long and short. So there's FJ Capital. Then Aegis Financial, that's AEGIS Financial, deep value, good credit. And then Donald Smith and Company, which is one of the coolest stories ever. Donald Smith and Company was started by Donald Smith back in the 70s, and he started working for a home insurance company. And he was running their investment portfolio, and he spun it off as a company, and he kept part of their portfolio as a client, and he just grew it. He takes the market and he separates it into quintiles by price to tangible book. And he only buys the bottom 10%. He's the only money manager on the planet doing this. Just 15% a year since the 70s. And now he's passed away here a few years ago, but the team that's there has kept that same approach. So these are just really great hunting grounds for deep value investors that have been compounding at high rates of return for long periods of time, and absolutely nobody's paying attention to.
Incredible.
So gives you a little bit of an advantage in searching for ideas, but always start with this private equity because there's great ideas. And like Apollo, Leon Black, famously said, they said, why are you so much better than everybody else? He says, because we put a 6 handle on our cash flow multiple. Okay. Everybody else is doing 10. And, KKR they're the original value investing leverage shop, I think.
Yeah.
But they have a real value bent. They're looking for undervalued businesses just like we are. They may do some things differently in terms of leverage, but great ideas. And you can really see trends developing in the economy and the markets when you go through their portfolios.
Awesome. Great advice there. And what would be your advice to someone new getting involved in investing today?
If you're new, first off, match this to your personality a bit. Okay. If you're young, recommend highly. If I was 20 some years old, I'd do half in deep value, half in small cap momentum. I think you're going to be able to appease both sides of your personality doing that. If you've got a strong leaning one way or the other, then you can concentrate 100%. I would do 50-50 if I was going back and starting all over again. But, absolutely, you need to read The Intelligent Investor. You need to read The Aggressive Conservative Investor. You need to read Navalier's book, Wes Gray's books, Toby's, to get a grounding. Read everything. That's the best advice I can give you. It's read both sides of everything. And I don't care if this is one of the healthcare books or diet books that you see, or markets or politics or whatever the issue is, read both sides. Don't just accumulate opinions as you go through investing, markets, life. Think, see both opinions, read them, study them. This is really, really important in the markets. Yes, read Ben Graham. Absolutely. Also, read William O'Neill, right? Because if you understand, even if you don't adopt that style, if you understand what one side is saying about your side and how what happens on that side is going to impact your side, it makes you a better investor.
Absolutely.
So just read everything. That's the best advice I have for a young person in any field, but that's read everything on steroids when it comes to your finance and investing.
Awesome. And what are some of the best places to reach you and learn about your content?
On the blog, obviously, Substack, just Tim Moen at Substack. I hesitate to do this, but I'm going to do it anyway. I'm going to give you guys my personal email, and I will answer questions unless they're, even if they're rude, I'll answer them out, but I'm really good at being rude, so be careful. cmelvin@gmail.com. So if you've got questions, comments, you want to know more, we are kind of we're figuring out what's next, right? We've got the Substack. That's a free platform for now. We're doing some projects at benzinga.com, trying to see if that's going to go anywhere. So we're kind of deciding what's next as far as what we're going to publish and where we're going to publish it. So we're at a juncture here for the next and final path down the road, but definitely going to stay in financial publishing. I like it. I'm an outlier in that particular industry in that we use a deep value, long-term oriented approach. So yeah, just email me, guys, with questions, concerns, thoughts, ideas. Always happy to have a dialogue and a conversation.
Awesome. Well, thank you for your time today.
Hey, I really appreciate you having me on. I've seen several of your other podcasts. I have read your Substack, and I really appreciate the opportunity to come on today. And sorry I kept you so long. I'm long-winded.
No, thank you. It's been awesome.
Okay, thanks.
Thank you for listening to today's podcast. For more information, please go to securityanalysis.org. Subscribers to the website get early ad-free access to podcast episodes in addition to weekly in-depth profiles of companies.